Hello, hi. My name's Jerry Miller, the founder of Trendsignal. This is part of our Monday Market Insights series. Gosh, it seems like all I'm talking about is central bank monetary policy, inflation, but it very much is the focus of everyone's minds now, investors globally now, concentrating on what central banks are up to. Um, with that in mind, what we're going to do is to start by looking at what happened with the Federal Reserve's rate announcement last week, and also the prospect for further rate moves. Before I go any further, I think it's probably best to look at actually what happened. So I've just opened up the countdown to FOMC. It's a page from the Chicago Mercantile Exchange that tells us where interest rates are expected to go in terms of forward pricing of those traded contracts. And as you can see, we've already moved rates up 0.75% last week from 0.75 to 1%. They have a band for the target rate, the Federal Reserve, and the target rate was increased to 1.5 to 1.75. That's 0.75%. It was not on the cards. It was a possibility. 0.5% was a shoe-in. I think the markets took it okay, and I think the reason why they took it okay was that Jay Powell, the chairman of the Federal Reserve, actually went to some pain to explain that moves of this magnitude would not be commonplace. So I think initially on the back of it last Wednesday, the markets did actually rally modestly. I think they've taken their medicine and thought, well, it won't be so bad in the future. And the future, let's have a look at it. So we're expecting it. This is what we or the markets are expecting the target rate to be at the next meeting, which is on the 27th of July next month. In July, 2.25 to 2.5%. That would be another 0.75% rate rise. So, Jay Powell, the market sort of disagrees with what you're saying. And not only that, when we look at the September meeting, where they're seeing another rate, 0.75% rate rise. So it's going to have to be quite aggressive, the moves by the Federal Reserve, and they've never shied away from stepping up to the plate. And by year end, we can see that interest rates are expected to be somewhere between 3.5% and 4%. Now, I sort of think about that and think, gosh, that sounds really high. We've had record low interest rates for some period of time, not just in the US, but in Europe, in the UK, and in other developed and developing countries. But if you look at where interest rates have been in the US, you can see that they can go a lot higher. Before the great financial crisis, interest rates were at 5.5, 5.75% in the US. So really, having them go up to 3.5 to 4% is not exactly um, out of line with past events. And with inflation hitting a 40-year high, the last reading was at 8.6% and forecast to go higher. I think it's highly likely that rates will end up close to that 3.5, 4% level by year end. So next, let's have a look at what happened with the Swiss National Bank. Normally, we don't even consider the Swiss National Bank. Believe it or not, they haven't raised rates for just over 15 years. And last Thursday, there was no prospect, it hadn't been discussed and indicated by the central bank that they would consider raising rates. Anyway, what happened was that the Swiss National Bank raised rates by 0.5%. It is an aggressive move, but the Swiss National Bank have kept their fixed interest rates at minus 0.75% for quite some time, and months go by without any sign that there's going to be any move. Clearly, the global effects of inflation are affecting everyone, including the Swiss, hence the reason why they've raised rates to ward off inflation. And let's face it, central banks' central mandates are to maintain price stability. If they don't use interest rates to tackle it, what else do they really do? It's a key plank of what they should be up to. Anyway, they raised rates. The effect on the markets were quite sharp. The US indices, which had had an okay end to the day the previous day after the Fed raised rates by 0.75%, markets went into a complete tailspin with the S&P 500 off 3.5%, the Nasdaq off 4.1% last Thursday, in reaction to a sort of a global move by central banks. And we also know about the Bank of England. I'm going to talk about that in a second. Also raising rates last Thursday, and it's just really there's the only thing central banks can do now, and they're all rushing to play catch up. And there's a lot more in the pipeline if inflation is persists the way a lot of economists expect it to hang around. So we fully expect interest rates to reach the sort of levels that the markets are predicting and more. Of course, it does depend on inflation, but all of that is governed by the post-pandemic sort of supply chain blockages, but also the more recent Russian war in Ukraine that has caused a massive spike in energy prices that affect so many aspects of business, logistics, production of a lot of um, chemicals. It's used in a lot of industries, plastics, etc. So the effects will be felt for quite a few months to come. So finally, the Bank of England. I mentioned it a couple of minutes ago that the Bank of England raised rates. There were rumours, and it was a strong possibility actually, that the Bank of England's rate setting committee, the Monetary Policy Committee, would raise rates by 0.5%. But in the end, they raised rates by 0.25%, a quarter of a percent. And this is the first time that interest rates have been above 1% in, gosh, over 20 odd years. Sorry, over 12 years, 12, 13 years. Last time was in 2009. So it just goes to show you how low interest rates have been, not just obviously in the UK, but across uh, the developed and developing world, really, since the great financial crisis and then the pandemic. Um, it's even more painful here in the UK. The Bank of England is forecasting inflation is likely to hit 11% before the year end. With interest rates at 1.25%, I do think it's highly likely that we're going to have at least two, maybe three more rate rises, with the possibility of a jump of 0.5%, depending on what happens. And I think the bank are a little concerned, and that's probably one of the reasons why they didn't raise rates by 0.5%, because we're more than likely already in a recession here in the UK, although a recession, a technical recession, is actually 2 quarters of negative growth. So to get 2 quarters of negative growth, we're going to have to wait around until November to find out that that had occurred, by which time we probably won't be in uh, a recession. We'll see. Thanks very much for listening and watching. Bye for now.